Good day to all and sundry. My name is Samuel Obriabwa. This afternoon, I'll be having a presentation on how business analytics has impacted the performance of the banking industry in the UK. Now, my presentation will take form in this structure. First of all, we'll be looking at the list of figures, the list of tables. I'll talk about an executive summary of my presentation. I'll give an introduction, background to the presentation, concept of business analytics, industry dashboard. I'll be looking at the definition of the various variables that I'll be using, and then I'll be moving on to descriptive analysis. After the descriptive analysis, we'll look at correlation analysis. From correlation analysis, we'll move to regression analysis. Then I'll make some conclusions and recommendations. Now, first of all, this study focuses primarily on the performance of the banking industry in the UK and some of the factors that affect it. It helps also, project the performance into the future and recommend ways by which it can be improved. The yearly data that I gathered spans for the period of the last 10 years. Then also we'll be looking at descriptive and inferential analysis that are used in the analysis, and the fact that it was gathered from 10 firms in the banking industry in order to generalize my results. Also, the inferential statistics will help me examine the factors that contribute to the performance of the firms within the industry. And then lastly, the impact of the capital I employed is positive while the shareholder funds is negative. This calls for a thorough investigations by operations in the industry to find the optional point of shareholders fund to ratio and also help maximize shareholders' wealth. Now, moving on to my introduction. The purpose of this study, as I said earlier, is to examine the performance of firms in the operating banking industry in the UK. It is going to be measured in terms of return on shareholder funds, and also I'll identify some of the factors that impact the performance and recommend some ways of improving it. Then the yearly data that I gathered was from FRAME, and as I said, it covers a period of 10 firms from the last 10 years, which is 2014 to 2023. And then the results are presented together with the interpretation, which can serve as a guide for management of firms in the industry to improve their performance, not just limited to one firm. With a background, the banking industry obviously plays a very important role in the modern economy of every country, and it attributes to the real output growth to a stable banking sector in any economy. Then the study also further noted on stable banking sector, which increases uncertainty and the negative impact that it has on future output and growth. Also, the UK financial sector plays a crucial role in promoting the domestic economy, both in the short and long-term run. Lastly, it highlights the importance of the banking industry and poses the need to examine the performance of the industry and how well it can play its important role in ensuring that there's financial stability in the economy. Now, moving on to the concept of business analytics. What do we mean by business analytics? It's the process by which models are used to solve various kinds of business problems. So there are so many models that are being used to solve business problems, but this one is specific. And it talks about a specific model or the two or more models which can be used to solve various problems within a business company or an industry. It is also a combination of skills, technologies, practices, which analyzes business data to transfer and informed decision making for future direction and investment plans. And also, business analytics is widely applicable in different industries. For example, as is being seen by Bansal Shukla in 2020, it was adopted in the application to collect and analyze data and identify different customer segments in the insurance sector by predicting customer sentiments. And it also helped in the formulation and recommendation of different insurance products, which met some specific needs of the customers. Moving on, the study also helps business analytic techniques to examine the performance of the banking industry in the UK and the factors that affected it and suggest effective means by which it can be improved. Then now let's move on to the industry dashboard. When you look at the graph, you realize that it shows the industry performance of the banking sector in the UK. And as I said, my presentation with the industry dashboard is measured in using the return on shareholder funds. It is measured by the portion of shareholder funds that is earned averagely on yearly basis. And it also shows that there's an imbalanced movement of the trend for the past years. And it also shows the importance of the study, which is also to identify some of the factors affecting its performance, to improve on it, and also maintain high returns on the shareholder funds. Moving on to the average return on shareholder funds by firms, we realize that the chart is showing an average return on shareholder funds by the firms over the years as well. And the bank with the highest returns obviously is the Bank of Scotland, which could be seen with an average of 13.9%, and is being followed by Santander Bank with an average of 10%, while TBC Bank sits at the lowest position. If you look at the chart, it's sitting with an average of 4.8%. This result shows how significant differences in the performance of firms will help examine factors that influence the performance in the industry. Now, let's look at the definition of some of the various variables that I've used so far. When you talk about return on shareholder funds, you are looking at profitability, which is calculated as a percentage of profit tax to shareholder funds, and then turnover, which means the total revenue or income of a firm within a financial year, and it is measured as the sum of both interest and non-interest income of the banks. Now, shareholder funds, which is measured as some of the shareholders' contributions to the business, and it is measured by the net worth of a firm, deducting all liability from total assets, and capital employed, which has to do with the total investment that has been put to generate profit for a financial year and is calculated by the total assets minus all liabilities. And finally, I'll talk about the number of employees, which has to do with the headcount of total employees in the firms, and it includes the model to help determine how employee size affects the performance of an organization, which is obvious that the size of employees within an organization affects the performance of the organization. Now let's move on to my descriptive analysis with the statistics that I use. Now, when you look at the table, you realize that it is showing the statistics of variables over the past years and the average return on shareholder funds as well, which is 8.04. And it indicates that in the industry, the industry can expect an average of 8% returns on their investment in a year. Now, the minimum there, which is in negative 11.62 with a maximum of 24.67, also indicates that some of the industry make losses in some years, and while others also make up to 24.67% in a year during that same period, which can be seen over there. And the skewness, which is also in the negative of 0.44, also indicates that there's slightly more of the data which falls below the mean value, as it could be seen on the statistics. And then you could also see that of the mean turnover. And then in conclusion, you realize that the shareholder funds have an average of over 1 million in the figures as is being shown on the slide. And while the capital employed is also over 1 million as well. And the average of the employees of the firms in the industry, which is around 62,000. So that is that on the descriptive analysis. Now moving on to correlation analysis. The matrix shows that there is a relationship between the variables, and then it helps determine the degree and direction of the relationship between the various variables that are employed. It is also important to know that the turnover or the shareholder funds, the capital employed, and the number of employees are all transformed into the log form. This is to ensure liability and improved interoperability, since returns on the shareholders' funds is calculated as a percentage. Now, the results that is being seen here shows that returns on shareholder funds has a correlation of 0.0899, with a turnover of 0.0617, and also with the shareholder funds of 0.1189, and the capital employed is also seen as 0.0365 with number of employees. And it indicates a strong correlation between the relations of the shareholder funds with the turnover, while showing the correlations of shareholder funds, capital employed, and the number of employees in that order. Now, moving on to regression analysis, you realize that the regression model that I use is linear regression model, and also it analyzes and examines the impact of one variable on the other, and the dependent variable in this case is the returns on shareholder funds, while turnover, shareholder funds, capital employed, and number of employees serve as independent variables. However, while the capital employed has a positive impact, shareholder funds also have a negative impact on the returns, as it could be seen on the matrix. But the turnover with a coefficient value of 2.141 and a positive value or a p-value of 0.09 indicates a significant positive impact on the 10% level. It didn't show a negative impact. The impact is positive. Therefore, you realize that the R is 0.094, and it indicates the model and explains about 49% of the variable as is seen on the matrix. More of these statistics is 6.45 with a significant value of 0.00, indicating that the model is correctly spelled and the independent variables jointly after the dependent variables significantly. Now, moving on to my conclusions and recommendations, we realize that the results from this study shows an imbalanced trend in the performance of the UK banks over the years. It is indicated by the inconsistent movement of the retained shareholder funds over the past few years. And then the performance of the firm significantly differs, which is shown by the average returns on the years. And it emphasizes the minimum negative value, which indicates some of the firms at a point during this period made losses. And also, it is evident from the analysis as the capital employed have a significant positive impact on the performance of the bank, which is then therefore recommended that the bank should increase their capital employed to the optimal level to improve their performance. And furthermore, on the other hand, you realize that the shareholder funds had negative impact on the performance of the banks. And therefore, it is important that the management should ensure an optimal shareholder funds to assess ratio to enhance the financial performance. And then lastly, the turnover is another factor that contributes to the performance of the bank. And it shows that it also shows that a device to means to improve on their earning of both interest and income. So thank you so much. And that's the end of my presentation.